Hi everyone, I hope you guys are all doing very well. I just wanted to do a quick video here just touching on why we haven't seen a significant spike in inflation since the crisis in 2008, the most recent financial crisis. A lot of times, and I wanted to make this video just because a lot of times on some of the comments in the videos, and also too just in the quote real world, whenever I talk about a lot of these economic issues, the most significant question that I get is, so if the Federal Reserve printed all this money and engaged in a significant monetary expansion, why haven't we seen the correlation with rising prices in a significant way? And to be fair, they're kind of right. Inflation has stayed around 2% in the last few years. That's in Canada as well and the United States. So they do have a point when they do kind of hit back and kind of question where this new inflation is supposed to be because of all the money printing. Before I jump into the main points of this video, I just want to thank everybody for all of their significant support on the last video that we made on the channel. It was entitled "The Laws of Gold Destroyed." It was our first video that had over 1,000 views in the first 24 hours, and it also got a lot of great comments. So I just wanted to thank everybody. It's greatly appreciated as always. But just jumping into this video, again, what we're trying to do is just show why we haven't seen a significant spike in inflation, even given all of the Federal Reserve's monetary expansion over the last few years. And what we'll do first is just look at this article. It was written by David Price. I'm pretty sure not the baseball player, but nonetheless, it was put out by the Richmond Federal Reserve, the Federal Reserve that's based in Richmond, Virginia. So I always like using the Federal Reserve's articles. It's a kind of lends legitimacy to the arguments here when we use the Federal Reserve's own articles and numbers. But the title of this article is "Where the Newly Created Money Went. Monetary Expansion Has Led Banks to Park Huge Excess Reserves at the Fed. For now." And I think that "for now" is a pretty ominous "for now." But let's jump right into the article. What I'll do is I will read out some of these important paragraphs. I have highlighted them, but it is probably important to break it down paragraph by paragraph where there is some important information provided. But just starting in on the first paragraph here, it reads, "In response to the financial crisis of 2007-2008 and the recession of 2007-2009, the Fed has carried out an unprecedented monetary expansion by purchasing a variety of financial assets in large amounts, especially treasury bonds and mortgage-backed securities. The monetary base, that is, the total of bank reserves and currency, has more than tripled from June 2008 to March 2013. And I should just mention that this article was written in March of 2013. But what we'll do is we'll just look at the Federal Reserve's own charts. Here's the monetary base that Mr. Price was talking about. He was writing somewhere in here in March 2013. So when he wrote this article, it had tripled to about $3 trillion. However, you can see from this chart, it's gone even higher since that time. And right now, we're right about at the $4 trillion mark for our monetary base here. It has come down, which is pretty significant. That's something to watch, just to see what's happening with the monetary base, but I think that it has kind of boosted back up over the last couple of months to get closer to that $4 trillion mark. But there's the chart there. So he is correct to say that there's been a significant increase, and you kind of really need to break this down for what it is. You kind of need to be almost an economist or even I guess almost like a scientist to break down some of these words. But when they say monetary expansion, again, that just means printing money. They're expanding the monetary base. But also, it's very interesting to notice, again, that treasury bonds and mortgage-backed securities is what they bought. We should note that these mortgage-backed securities are the worthless mortgages that the banks lent out in the subprime crisis. So a lot of these assets that they have on their balance sheet that are sitting as excess reserves, as we'll see, are things, I guess, like the mortgages that are for $400,000, but are probably currently worth a lot less than that. And then also too, we should just know that the monetary base, again, the chart that we looked at, the total of bank reserves and currency, those are very liquid funds. Those are going to be the deposits that are sitting in commercial banks. And then for currency, again, that's just the circulating notes and coins that are currently in society. So a lot of information is just kind of passed along in that first paragraph. It's important to kind of know what we're talking about with some of those words. And so here, this is a great question and what the article is looking at. So then, where's the inflation? And so just moving down to this paragraph here, it states, the seemingly missing money can be found, for the time being, in an accounting entry at the Fed known as excess reserves. This figure refers to the amount of reserves that banks and other depository institutions keep at the Fed beyond the level of reserves that they are required to maintain there. And since 2008, they've skyrocketed 850-fold. And so let's just look at the chart for excess reserves. And again, the author has hit it right on the nail. Again, it has been a significant increase since the 2008 crisis. And right now, it's gone up even more since this article was written again. Right now, we're sitting at about $2.4 trillion in excess reserves. Again, too, just like the monetary base, we've seen that there's been a significant decline. Well, not significant, but it was inching closer to that $2.8 trillion mark. And now, again, it's dropped below 2.4, but again, it looks like it's kind of popping right back up to the $2.4 trillion mark. So that's where we sit with the excess reserves. So basically what happened is all of those treasury bonds, those assets, treasury bonds and mortgage-backed securities are sitting as excess reserves with the Federal Reserve Bank. And let's keep going. So they make the important point, the significance of high excess reserves is that banks can draw them down to make loans, which in turn creates deposits, money, in the broader economy. Thus, if the Fed does not manage high excess reserves properly, they create the potential for high inflation. The $1.7 trillion question, and again, it's $2.4 trillion right now, so that would be the $2.4 trillion question is, can the Fed do it? And that is, can they avoid high inflation? Now, that's where we sit. We could end looking at this article here and move on to the more important article next, but just by way of background, what happened was there had been legislation, the Financial Services Regulatory Relief Act of 2006. They were going to start paying IOR, which is just inflation on reserves. They were going to start paying it October 1st, 2011. However, because the financial crisis hit in May of 2008, in the midst of the financial crisis, the Federal Reserve asked Congress to move up that date. And as we can see here, Congress granted the ability to pay interest on these excess reserves. And I think they give the date, but it was, I guess, in 2008 they started allowing them to pay interest on the reserves that are currently sitting with the Fed. And also, too, let's just look at these important paragraphs before moving on to the main point of this video. The question of timing, so whether or not the Federal Reserve can prevent what they call high inflation in this article. Just continuing to read. If banks believe that they can earn more by reducing their excess reserves, and if they appear likely to use their excess reserves to expand their activities faster than the economy is growing, the Fed can avoid the torrent of money simply by raising the interest rate that it pays on reserves. That is why the high excess reserves do not necessarily set the stage for high inflation. So what that paragraph is saying, that the Federal Reserve can prevent all of that new money that's sitting as excess reserves with the Federal Reserve by increasing the interest rate that they're paying on those reserves. Right now, the interest rate is 0.25%, so 0.25. And so this article is arguing that If the banks appear that they're going to start lending out that money, and it looks like they're going to start lending it out in a significant capacity, what the Federal Reserve can do is they can incentivize the banks to keep it with the Federal Reserve and not lend it out too quickly, simply by increasing the interest rate that they pay to the banks to keep it with the Federal Reserve. So that's what they're arguing. And again, too, it's quite funny to me when I read this, when they say high access reserves do not necessarily set the stage for high inflation. I think that that's getting ahead of themselves a little bit. I kind of had the analogy in my head that it would be like if you take 24 drums of gasoline and pour it all over a house, and then lighting a candle in the kitchen, for example, and then trying to say, well, pouring all this gasoline all over the house doesn't necessarily set up a situation where you can have the house burning down if you do light a candle in a part of the house. I don't know about you, but I'm definitely not going to go to bed in a situation like that. So I think they get ahead of themselves. I do think that if you're going to create access reserves like that, it's pretty kind of sets the stage quite significantly for high inflation. So again, too, they are fair. I do like this article. I find the author to be extremely fair. They ask, but is there a risk of the Fed getting the timing wrong, that is, timing for raising the interest rates? If it doesn't act quickly enough to raise the interest on reserves, or if it doesn't raise the rate enough, an unwanted rise in inflation or inflationary expectations could be the result. Again, too, don't let that wording fool you. They mean a significant amount of inflation in a short amount of time. Again, too, they just kind of say that the Fed's historical track record in that regard has been reflected in practice. The timing of monetary policy is an art as well as a science, and one that is conducted by human beings. So they do recognize that it is quite difficult for the Fed to know exactly when they would need to raise interest rates. And very importantly, this shocked me, and again, it's a great part of this article. So it says, in addition to the question of whether the Fed would know when to act, some see a question of whether the Fed would have the will to do so, and whether Congress would permit it. So there are political ramifications to all this as well. It's not just the so-called experts sitting on these Federal Reserve boards. It says, these observers are concerned that the Fed might consider the effect of raising interest rates would have on the cost of servicing the federal debt. And again, an excellent part here says, if the Fed were to raise the rate from its current 0.25% to 2.25%, for example, then at the present level of reserves, and remember this is when reserves were at $1.7 trillion, not 2.4. If it was at the present level of reserves, it would be paying the banks some $38.2 billion per year, which is up from zero, so the banks weren't earning any interest on these reserves in September of 2008. Again, too, they weren't allowed to, as we saw with that new legislation, prior to the new legislation, and a far cry from the $359 million that the CBO forecast when Congress first approved the payments in 2006. So as you can see, based on all of this, I think it's a pretty kind of almost an impossible task of raising these interest rates in a significant manner, just given how much interest would need to be paid to the banks for free. They get that money for free, having done nothing on the backs of American taxpayers. And again, too, just the amount of interest that they would have to pay the banks makes it pretty unlikely that they would end up using the raising of the interest rates on reserve to really stem that high inflation getting into the economy. But let's scroll down and look at the more important article, the one that I really want to point out in this video here. This is an article, again, too, from the Federal Reserve, this one based in Minneapolis, though. It was written more recently, so in November of 2015. And the title of this article is, Should We Worry About Excess Reserves? And the subtitle being, Through Fractional Banking and High Excess Reserves, Banks can create sudden spikes in financial liquidity and possibly inflation as well. financial liquidity just meaning money. So sudden spikes in new money that would be created. Let's start right on this first paragraph. It says, banks in the U.S. currently hold $2.4 trillion in excess reserves. Let's go back to our Federal Reserve charts, and just looking at the excess reserves, again, right around that $2.4 trillion. So the article does get that right. Again, too, this is a very fair article, excellent from the Federal Reserve itself. Goes on to state, to put this number in perspective, the monetary base of the United States, which is the sum of all currency outside the Federal Reserve System, plus both required and excess reserve deposits by banks at the Fed, is $4 trillion. So 60% of the entire monetary base is now in the form of excess reserves, compared to roughly 0% before the crisis in 2008. So if we look at this again, at our charts, if we look at the monetary base, which currently sits at $4 trillion, out of that $4 trillion, which significantly increased in 2008, out of this $4 trillion, $2.4 trillion, 60% of that is sitting as excess reserves with the Federal Reserve. Great point by this article, and already when I read this introduction, I liked where the article was going. And just at the bottom here, it states, currently, there is about 12 trillion of such liquidity in the United States in terms of currency and easily accessed bank deposits held by firms and households. So let's go back to our charts just quickly. When they state that the $12 trillion mark, what they're talking about is the entire M2 monetary base, the M2 money stock. So again, too, very fair. They got that exactly right. M2 is sitting even higher now in the last couple of months, but right around the $12 trillion mark. Let's continue, and again, the most important parts of this article. While the correlation between changes in M2 and prices is not tight in the short run, comparisons across longer time periods and across countries are clearer and more convincing. And again, very important, greater liquidity is associated with higher prices. That's a very important point, and I was very shocked to see this in a Federal Reserve article. Like I said, though, these articles have been more than fair, and in my opinion, do paint a very vivid and true picture of what's happening with all of these the monetary numbers. So basically what that's saying is, although a rise in M2 in the total money stock isn't perfectly correlated with prices in the short run, so just because you increase M2 doesn't mean prices are going to increase. It does state that in the longer run, so even though you can hide it as excess reserves, in the long run, greater liquidity, that is an increase in M2, is associated with higher prices. So I like that. They're saying just because you increase M2 in the short run, you're not necessarily going to see it reflect in higher prices. In the long run, there is the correlation that when you do increase M2, you will see higher prices. And then let's scroll down here, and this is the main point that I want to make in this video. This is actually quite fascinating. It says, bank actions alone could cause a large increase in liquidity, and then in brackets, when banks hold substantial excess reserves because of the nation's fractional reserve banking system. Again, it's not often that you see the fractional reserve banking system in an article, so I like that. Goes on, since each dollar of bank deposit requires approximately only 10 cents of required reserves at the Fed, then each dollar of excess reserves can be converted by banks into $10 of deposits. That is, for every dollar in excess reserve, a bank, and they stress bank, it's not the Federal Reserve or not Congress or politicians. A bank can lend $10 to businesses or households and still meet its required reserve ratio. And since a bank's loan simply increases the dollar amount in a borrower's bank account, these new loans are part of the economy's total stock of liquidity. Thus, very important, Thus, if every dollar of excess reserves were converted into new loans at a ratio of 10 to 1, the 2.4 trillion in excess reserves would become 24 trillion in new loans, and M2 liquidity would rise from 12 trillion to 36 trillion, a tripling of M2. So quite fascinating, and again, that's so important. It's something I think I've made a couple of videos on right now, but basically what they're saying, if you look at the excess reserves, because of fractional reserve banking, this $2.4 trillion in excess reserves can be lent out at a 10 to 1 ratio, which means really what these banks can do, instead of drawing on only being stressed here, $2.4 trillion, they can actually lend out $24 trillion. And if we go back to our M2, really, when you add that $24 trillion in excess reserves and loans they can lend out on those excess reserves, you would have an M2 of not 12 trillion, but an M2 of 36 trillion. Again, increasing it by 3 times. So that's a very important point, and I'll probably name this video something along the lines of the hidden tsunami of inflation that could be coming. And again, it sounds almost conspiratorial, or something that couldn't happen, or being dramatic, like there's some hidden inflation out there that could be coming. But again, even from these Federal Reserve articles, and if you are familiar with those charts with M2 and excess reserves already, again, it is a I won't say likely scenario, but it's definitely a possibility that based on those excess reserves, once they do start lending them out, and if they do use the fractional reserve system to lend it out at a 10 to 1 ratio, you could have a significant spike in the money supply. And again, too, like they say, when you have a significant spike, they say it just right at the top here, when you have an increase in M2, in the long run, it is going to be associated with higher prices. Very important as well, these decisions are made by the banks. And again, if you're hoping that, well, maybe the banks themselves will rein themselves in, and they won't lend it out at a very quick rate, or they won't lend it out at the 10 to 1 ratio, you have to question, do you really believe that? Just look at the recent subprime situation that happened. You didn't see a lot of sort of self-policing or self-regulating, preventing what could really hurt the economy down the road. And also, too, as you saw, if you're hoping that they increase interest rates on the excess reserves to try to prevent them from lending out the money at a significant rate, again, too, are they really going to increase it to a significant enough rate where you're going to have to pay banks trillions of or billions of dollars that's going to have to be paid by taxpayers? I don't think so. I don't think that there's the political will for that. So I just wanted to point that out. Again, 2 great articles, in my opinion, from the Federal Reserve banks. Again, too, if you're looking for them, the Richmond Federal Reserve in Richmond, Virginia, and then the Minneapolis Fed. So again, too, that's my answer to anyone that's asking where the inflation is. Right now, again, it's hidden quite well away from the public. The increase in excess reserves is kind of keeping everything non-chaotic at this point. But from the Federal Reserve's own articles, you could see a tripling of M2 just based on those excess reserves. Again, a tripling of the total money supply of M2. So that's the 2 articles that I wanted to touch on here. I would love to hear what you guys think of the articles. Again, I will just mention that my brother and I were trying to get a more consistent schedule for the CoinCasts. We have the next 3 CoinCasts already planned out with some topics that we want to touch on. So we're hoping, it's Monday when I'm making this video, the 21st. We're really hoping to get 2 CoinCasts out this week, and I hope you guys enjoy those 2 new CoinCasts that we're going to put out. But again, too, I'd be happy to hear what you guys think about these two articles. Also, too, if you could like the video or subscribe to the channel, we'd also greatly appreciate that. So there it is, just my answer to where the inflation is. Thank you very much if you've made it this far. This is another long video. I hope you guys enjoy the long videos. Thank you if you made it this far, and be on the lookout for the new CoinCast this week. But thanks a lot, guys. Thanks for listening to this for so long. Hope you guys have a great week upcoming, and we'll see you guys soon. Bye for now.